Hi, this is Don Gooding with the 4 Colors of Money for Entrepreneurs. In this series of videos, I'm going to talk about scaling your company. And I'd like to start off with the question, what do they mean by scalability? Like a lot of words in the English language, scalability means slightly different things to different people. So I'm going to talk about 4 different types of meanings of the term scalability. So first of all, there's a connection between the operations and the financial results that sometimes people mean when they're talking about scalability. The notion here is that you can do more and more of what you're doing now to increase revenue predictably, and then as revenue grows over time, your operating profit margin will actually increase. So again, you're ready to do more and more that yields revenue increases reliably and predictably, and over time that increases the profitability of the business. That is a scalable business to some people. A second meaning of scalability has to do with, well, you can kind of summarize it in the phrase, success breeds success. So if you have more customers, that can accelerate the growth of even more customers because of virality or network effects. As you add features to your product or you add more products to your product line, that in turn accelerates the growth of revenue. As you add more distribution channels, that accelerates the growth of revenue. So if you have a scalable business, that means that as you get bigger, that bigness will actually make you grow even faster. The other 2 meanings of the term scalable come from the venture capital perspective. One has to do with a growth rate. Can your business grow its enterprise value at a rate of 50 to 100% every single year, compounded for the next 5 to 10 years, or maybe even longer? Those kind of businesses, in turn, grow the value of their investment. So those are scalable. And then there's also the phrase unicorn, which is the translation in terms of scalability of an enterprise that could reach a valuation of at least $1 billion US. Many VCs want to invest in companies that have an opportunity to reach that scalability of $1 billion in valuation, or alternatively, $1 billion in revenue over time, because these are the kinds of companies that can either go public in an IPO or be acquired by a very large corporation and yield that 10x return that they are looking for to make all of their numbers work. So, as you're thinking about your business, how scalable are you in terms of these 4 different definitions of the term scalability? So if you think that your business could be scalable, then the next question to ask is, are you actually ready to scale? And unfortunately, there's no simple answer to this question. Even if you were able to get the money that's necessary to scale, lots of companies have failed along the way of trying to scale even when they had the money, and we don't want that to happen to you. So instead, we're going to talk about 4 more questions. The first question to ask yourself is, have you achieved product market fit? So the second question you're going to have to ask is, can your team scale? Then the third question is going to be, can your business processes scale? And then finally, have you thought about and addressed the structural barriers to scalability that your business might be facing? The reason that product market fit is so important in relationship to scalability ties into our first definition of scalability, which is connected to doing lots more of what you're doing now in order to achieve revenue. So before you've achieved product market fit, you're actually still fiddling around with product features and pricing and channels and marketing messages. So you're actually not ready to do lots more of what you're doing now. So the question then is, what are the signs that you've actually achieved product market fit? So I'm going to borrow from a presentation by Jason Chinchette. He's a serial entrepreneur here in Maine, and he also got his MBA. He worked for several venture capital-backed companies, but he bootstrapped his company, Liquid Wireless, all the way to early scalability and was able to sell it for $3 million all for himself. In any case, Jason really wanted to understand this question: what does product market fit actually look like? And so he looked out and saw multiple definitions. Really helpful, right? There's always multiple meanings of these phrases. So, according to Brad Feld, very well-known angel and venture capitalist in the United States, reaching a monthly recurring revenue, MRR, of about $100,000 per month, that's some indication that you've achieved product market fit. Another very well-known venture capitalist, Mark Andreessen, is a little bit more vague. He basically says product market fit is when you are in a good market with a product that can satisfy that market. A little bit too touchy-feely, I think, for Jason. So he saw three other indications from his research and what other people are saying of the fact that he and you might be achieving product market fit. So first of all, really knowing your customers, really knowing them by name, by organization, by job title, and that translating into having a strong pipeline of customers. So you can look out in the forecast and understand, because your product is fitting into a marketplace that you really understand, you have a strong pipeline of future potential customers in front of you. Another indication of product market fit is that you have very precise and positive unit economics. So what that means is that as you sell to a customer a set of products or an individual product, you know very precisely what the numbers look like. So what is the average revenue per customer? What is your margin on those products? And what does it cost to acquire that customer over time? And the net of all of that is positive. That is to say that you're making money. That's another great indication that you've achieved product market fit. And finally, having product market fit means you are able to understand what customers are going to want in the future, and therefore you have a very strong product roadmap. It doesn't mean when you've achieved product market fit that you've done everything with your product. Of course not. There's always room for more development because customer needs are evolving, but instead you understand what those needs are, and that translates into a very strong long-term-ish kind of product roadmap. This next slide from Jason was really an aha for me. The question is, how does your behavior as CEO change from before product market fit to after? From trying to discover a business model to scaling a business? Here are the 6 things that he found. First of all, before you've achieved product market fit, you're trying to conserve cash to make sure you have a chance to achieve that product market fit. Afterwards, you are investing in growth. Before, you're trying to find your opportunity. Afterwards, you're trying to seize your opportunity. Before, you're trying to keep the team small, so you're conserving your cash. But afterwards, you are growing your team. And in terms of the team, before product market fit, you need a small team that's got a lot of broad skills, but afterwards you're starting to hire specialists. Before product market fit, you got to stay flexible, and afterwards you're actually creating processes. And finally, before you're trying to maximize learning with everything you're doing, and afterwards you have to start maximizing efficiency. So these are a lot of big changes. I call this transition the process pivot. And it's pretty uncomfortable for a lot of founders to make these huge changes in behavior because it's 180 degrees in many cases here. And sometimes it's moving into behaviors and strategies that they're just not comfortable with. So in order to achieve scalability, as you approach product market fit, you have to get yourself ready for the process pivot. The final really important reason to pay attention to product market fit is that there are enormous dangers in premature scaling. How big are these dangers? Well, the Startup Genome Project said that of the venture capital-backed companies that they looked at, 70% of the failures were because of premature scaling. So how can that be? So if you're not quite ready and you get all this influx of cash, you end up wasting cash and time going down the wrong path if you don't have product market fit yet. Instead, you're focused on one thing versus finishing customer development. Maybe it's hiring lots of people, maybe it's acquiring lots of customers, maybe it's really cranking up your engineering effort, maybe it's doing a lot more fundraising, and you're committed to this path. You've committed to investors to go down this strategy you've sold them on, as opposed to paying attention to the overall product market fit to make sure the path is really correct. And so you're going down this path, you're burning cash, and you're not only losing time to pivot as is needed, but you're mentally not committed, not focused on the possibility that you have to pivot. And this is a big danger in premature scaling. Here's the rub, though. Venture capitalists aren't necessarily all that great at figuring out whether or not you've achieved product market fit yet. So it's up to you to figure that out. When you take in venture capital funding, they believe that you're going to commit on this path, and they're going to make sure that you're scaling things up, as you said. So it's your job to make sure that you've achieved product market fit before you take in those dollars, to make sure that you don't succumb to the dangers of premature scaling.